Nate from iFlip, CEO and co-founder.
We are an AI investment platform. That's what we do. We allow the average person to participate in the stock market with the effectiveness and the efficiency of an institution. That's the whole idea behind it. Everything comes out of the stock market. We want to find a way to participate and be part of it. So that is what we do. So I want to be very clear on what we're going to do. We're going to talk a lot about the state of the financial services space. All of you should know a little bit about it, or you wouldn't be here. The reason IRA Club exists is to give you control. We're just one mechanism inside of their whole suite of things that you can do with your money. And I'm going to talk to you a little bit about AI versus algorithms. There's a difference in the two. They are not the same thing. We'll talk about the landscape. I'm going to show you some examples of what the AI does at work. And I'm going to show you a couple of interesting findings that are presented to the world around investing in the stock market in particular. So I'm trying not to give away some of the punchline there at the end. So that's the idea of what we're going to cover today. So myself, I'm an entrepreneur, have been forever. This will be at the completion of our run at iFlip, whenever we sell the company or take it public or whatever we do with it. This will be my third one, my third successful one. I've started, grown, sold 2 other companies. I am the CEO of the company, and I am talk to you a little bit about my business partner in a minute. But we're out to do something very, very different. We're out to change the way the world invests. And on top of that, we have a very big purpose. It's to empower every individual to preserve, protect, and grow their wealth. And I know some of you have been on our website, or you've seen things where you think you need 50 grand or 100 grand or $1 million to invest in our platform. You don't. You just need to talk to us a little bit. We have a platform for everybody. When we say empower everyone, we mean empower everyone. We've built the most effective and the most efficient mechanism for you to participate in the markets that exists. Many of you are here for this reason, but the average investor, they've got a job, a 401k, they're in their regular workplace. They don't have any control over that. But the rest of your money you do. When you retire, you do. If you do real estate, you have control. But as a society, we've been conditioned by Wall Street to believe that a 9% return, because we all know those numbers. We see them, whether you're a CNN person or a Fox person, there's one consistent thing both business shows report, that the market returns 9% a year. Well, since we've been on an 11-year bull run, it thinks like there's no risk in that. Yeah, no risk, no problem. People ask me all the time, Randy, how did Flip do? What were your returns? Wrong question. What were your returns compared to the risk you took to get them? That's the better question. If they can't answer those questions, if they can't answer the risk, then you're talking to the wrong person. We also, as a society, as Main Street, we accept that advisor fees, Schwab, Fidelity, those guys, they're just too complicated to figure out. So we just pay them because, after all, they're only charging us 50 basis points. Oh, wait a minute, what's that? 0.5% of our assets, or 1% management fee. I can pay a 1% management fee. I'm going to clue you in on a few things today and show you that's not what you're paying. The modern investors who are doing it themselves, they don't know how to trade. If you don't believe that, go look at Robinhood. Look at all the millennials that are getting killed by meme stocks, and they're rich one day, poor the next. So we all turn to crypto. Let's trade crypto. That's the magic answer. But again, we don't know how. Oh, wait, we got to set up a wallet. Oh, wait, what's this broker thing and a key? I have to have all that stuff. So it's complicated. There are problems. And when we think about those problems, why do they exist? We live in a world today that's just immensely improved through predictive intelligence and automation. And I'm going to really break down the difference for you in a minute. But when it comes to the financial services world, we're told a couple of things. Number one, don't touch your 401k when you're done working, let it grow. Or if you're investing traditionally with a traditional IRA, they're saying buy and hold. The S&P 500 on average returns about 9% a year over its entire history. So if you stay in it long enough, you'll average 9%. That's what we've been taught. Stay the course, right? Or we have a bunch of money. We were born into a trust fund with lots of money, so we can afford people to manage it for us. Real expensive people, we're going to charge an extra, 1, 4, 5, 6% to manage it. Just let them do it. Problem with that is extremely expensive, and they don't actually return better than just owning the S&P 500. Or we have to do it ourselves. That's where all of you fall in. You all do it. You're all here to do it yourself. You're trying to find alternative asset classes to diversify your investment money into. And with the state of the markets right now, who can blame you? The markets are all over the place. Nobody knows what's going on. So we're going to talk a little bit about that today as well. But these are the problems we're trying to solve. And when you think about that statement, predictive intelligence and automation, really, which audience have the most to gain from this tomorrow? Because I don't believe any of you on this call would be thinking like, oh, geez, I need to get all my money invested today so that I can buy a Lamborghini next week. That's not how this audience thinks. That's not how we think. We're talking about target audiences that have the ability to take advantage of this over time tomorrow. And so I'm going to give you a few examples. I've just shown you a couple of these things. Institutions and advisors state the cost of missing the market's very best days is extremely high. We've heard this. This is the argument to buy and hold. Well, do they also tell you that if you sell and you move your money into cash, that they don't get paid? That 1% is an AUM fee, meaning it's asset under management. That means their fee only comes when it's invested. Also, they don't tell you, and I'm going to show you some other examples here in a minute, they don't tell you that almost all of them have a money manager that also gets a fee. That's not reported. Then they put you in funds. Those funds charge fees, also not reported. They don't have to report, not forced to, no legality around it. So if this is what they're telling you, if you miss the best days, it's a big deal. Let's just take a look at why we don't want to miss the best days. I'm going to make their case for them right now. So if you miss the best days and you lose a big chunk, right? You lose money. You must then gain money to recover it. So I'm going to go right down here to the bottom. Some of you might have been around in 2007 and 8 when the market took a 50% correction, and you may have been completely invested in it and you were in buy and hold. You're sticking it out and you're still there today. You then must gain 100%. So if you lose 50 to get to 0, you need to be at 100. You need to gain 100. Say that one more time. If you lose 50%, you must gain 100% to get to 0. The average time in the stock market it would take you to do that, it's 11 years, 12, 11 months. So basically a dozen years. So if you were in that in 07, you've made your money back and you've probably done well since then if you were really strong enough to tough that out. However, we like to say there's another way to do it, and these people don't share this with you. We simply say risk less. Remember I told you a minute ago, risk versus reward. That's the whole key. Our platform is built on risk versus reward. What kind of risk am I willing to take to get a specific return? So let's talk about what I just said. Buy and hold. So if you put $1 million into the S&P 500 in 1998, it would be about $5 million right now. That would be really good. You'd be very happy. And this is about a year and a half old, this study, but it all correlates. However, if you miss the 10 best days in the market, just the 10 best days over that time frame, 20 years later, you would only have 2.5 million. So which is better? Is it better to buy and hold and ride out the storm, or is it better and skip those 10 best days if you miss or is it better to miss those 10 best days trying to time it? This is the argument that says you can't time the market. However, there's one more piece, little I call it the rest of the story. They don't share all this with you. If you also miss the 10 worst days, So follow me here. Buy and hold, buy, but try and time the market and miss the 10 best days of the market. Or buy, miss the 10 best days of the market, but also miss the 10 worst days. Now look what happens. Your portfolio will go from 1 million to 10.7. Risking less is far more important than getting the top day, than being present for the best day in the market exponentially. They don't tell you this because then you're going to ask them the simple question that says, well, then can you move my money out and make sure it's in on those 10 best days, but then move it out for the worst days? Well, they can't. They don't have the skills or the tools to do it for large clients, large numbers of clients. So what does that look like on a chart? It looks like this. So, all right, I got multiple screens going here. So the black line, right? See what the black line is? That's your S&P total return. There's your black line. If you missed the 10 best days, you'd be down to here. Unless you also missed the 10 worst days, then you'd be way up here. This is my point around risk versus return. So we can't get too caught up in it because what do we risk? Now you look, there's certain days where the buy and hold actually went up a little more than this, and we missed some of the big spikes, but that's okay. We're willing to miss those best days because we missed those worst days. I hope that makes sense to you. Example number 2, why you don't invest. And this is from a study. I could actually do a whole hour just on these numbers right here to give you guys more color, but we don't have time. But I want you to understand what a mutual fund is. If you still have money invested with a professional person that has your money in a mutual fund and it's money you can move, whether you give it to Flip or not, you need to give it to IRA Club and then do something else with it because mutual funds are just too expensive. This is a study that came out in 2020 by Forbes. Mutual funds have some costs. There's disclosed cost. On average, it's 1.19%. That's what they have on the window. That's what you see when you go down there. It's like 1%. Wow, this is great. 1.1, that's all I got to pay. Awesome. And it's only on the balance I have. So, of course, they want me to do better. Isn't that what the TV commercial says? When clients do better, we do better. Well, of course you do because you're giving me a percentage of their balance, right? However, there's hidden costs. There's a lot of hidden costs you don't see. On average, those hidden costs total about 1.4% in actual fees on average across all mutual funds. Cost due to tax inefficiencies. They don't tell you that they operate outside of your best interest in the tax space. So you're going to pay another 1% in fees that are due to tax inefficiencies and them not managing it appropriately. And then sneaky behavior. It's about 2.5%. Funds report at the end of each quarter. How did they do for the quarter? How did they do for the year? Well, when you get right to the very end, they will sell the low performers, which you've lost in. They will then go buy something that's done really well. That's what they would call rebalancing, redistribution. However, that costs you about 2.5% on average. So if you can do the math across that, and I've told you what the average return is per year, it's about 9% in the markets themselves, the S&P 500. So you see how it becomes a daunting task to recover. People need to understand there's a big difference between an algorithm and AI. It's a process or a set of rules. Literally, that's what it is. If this, then that. Let me give you a stock market example of an algorithm. You could even have your own in your real estate investing. If interest rates get to 1% again, even, I'm going to buy 3 houses. That would be an algorithm. You could then go out and manually do it. In our world, it's automated by a computer. So Apple, or I'll take a real example from today. If Amazon ever splits and does a 20-to-1 split, I'm going to buy 100 shares. And then it happens, and then you go do it. That's what an algorithm is. If this, then that. If Apple hits $100, buy it. If the market drops 10%, sell it. Artificial intelligence is much different. Artificial intelligence is an algorithm. An algorithm is not artificial intelligence. Understand the difference. Artificial intelligence is an algorithm. However, it's a very advanced algorithm. For a standard algorithm, like a robo-advisor, like a Betterment or a Wealthfront, in order for their algorithms to do something different, a human must go in and program it to do something different. An artificially intelligent algorithm can change its own rules. Why? How does that work, Randy? I don't understand. Well, we, in our case, feed each of those algorithms data, massive amounts of data. We have many algorithms giving the parent algorithm, and there's actually 11 parent algorithms, data. Based on that data, the algorithm will then change its rules. So you might want to buy Apple today at 100. It might be at 99 tomorrow. It might be at 1 or 2 the day after that. So it's constantly changing. This is machine learning. The machine learns, and over time, it does nothing but get better. Simple question to ask. If the machine can change its own rules and does not require a human to intervene, then it's artificial intelligence. If it cannot, it's just an algorithm. So we like to talk a lot about that, and it's a big differentiator because we are the only pure artificial intelligence platform out there available to the average Joe. How does it work? Here's how it works. I'm going to show you in simple people terms like myself, and then for those of you that have a little more savvy in the investment space, I'm going to share with you guys next. So the blue line is simply the S&P 500 since 2017. You notice that's what it does. There's your big coat. It's over here on the screen. There's your big COVID drop right there. Okay, so you can see it. 2018, there's a decent drop right here as well. Okay, so what the AI is designed to do, it's to perform equal to or greater than the S&P 500 with about a third of the risk. We want to absorb less risk. How do we absorb less risk? The AI is programmed to continue to learn to predict big market drops. You can see right here, it skipped the COVID. 2018 was the first time this happened for us, right? Right here at the end of, at the end of 2017, no, 2018, right? 17, yeah, right here, 18, that little drop. So what you're looking at right there, is an entire year of the market going up and the AI not doing anything. You're just in it, riding along. So people would ask the question, Randy, why am I paying you a monthly subscription if it's just going to leave me in the market all the time? Well, the market didn't do anything. Then in October, it took them out of the market. It took our people out of the market. About 70% of them came out of the market. And then a month and a half went by. So now the market's still going up a little bit. You can see the little dot right there. The blue's going up. Actually, it's doing better than the AI. My phone's ringing off the hook. Why is this doing it? Well, Christmas Eve took a big drop, 10%. We were out of the market, bought back in, and created our first separation. Same thing during COVID. Look at this, almost identical to the market until right before. And we went down about 9%. We took a big drop. That was a fast drop, but got out. And then look, got right back in, created another separation. Again in 21, and we're out right now. We've been out since February of the market. Since early February, we've been out of the market right now while the market's doing. It's crazy. This is simple terms. But what that's done is that's put us about 100% ahead of the S&P 500, trading the S&P 500. And I hope that makes sense to you guys. I'm going to give you one more complicated chart. Here's what it looks like. Here's what it actually looks like in the trader's world. The little red dot lines right here, you see this where these little red lines are? These are the risk levels that the AI is monitoring. I'm actually showing you guys a little bit behind the screen. The blue dot, little tiny blue dot right there, means we bought it. Little red dot right there means we sold it. So you see what happens is, this is the perfect example. It's going up, it's going up, it's going up, it's going up, and it's sold for some reason. That makes no sense. Why did it sell? Well, Remember that 10 best days? We're willing to miss that best day because something it's predicting is about to happen. Well, nothing happened, so it went up, it went up, it went up, and then it had a little drawdown right here. And you see the red dot, the risk dot right there? Software bought. Wrote it up again, absorbed this little dip, then it turned the corner. This is COVID. Got out. Tried to get back in and then got right back out. So it then got in down here. This is the AI doing this, in, out, in, out. An average smartfolio is only going to make 8 or 9 trades a year. We're not about trading all the time. It's about avoiding the drop. Now, I'm going to show you guys something brand new. This has only been shown to a few people. It's a little fuzzy, but I want you guys to see this slide. We have, uh-oh, go man. Oh, no, 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 no. Yeah, I'm having happy finger clicks. I'll wait, it'll come through in a minute. So the idea here, one of the next step in the world of flip is cryptocurrencies. You heard me talk a little bit about crypto at the beginning. We've been mapping crypto, the AI has, for over 18 months. And we're not mapping all of them, just the big major ones. But we've now added, it actually will go live next week. We have added cryptocurrencies into our offerings. Inside that offering, though, we are blending the traditional equities and crypto. So I'm showing you right here. If you go back to 20, you can go back test it to 2016. But if you want to look at what the AI does, this is portfolio A, the S&P 500. It's Apple, it's Bitcoin, and it's Ethereum. You don't need to get a wallet. You don't need to set up an exchange. You don't need a crypto key. They're buying, just like buying Apple, you can buy Bitcoin, Ethereum, either one of them. You can buy them all just like that. And so what we've done is built what we call smart folios, like we have in the stock market, that include crypto. There's going to be 3 of these that are blended with equities, ETFs, and cryptos. And there's going to be one that's exclusive to crypto. Now, those have a little more risk, but you can see how the AI works. Market goes down, we stay in, and we get out early, right? So that's the idea behind it. We've put together a one-stop shop. Partnering with IRA Club makes it even more of a one-stop shop. Literally, we can help you with anything you need in the crypto space or in the stock market space. Real estate, you know, we have a real estate fund too, but that's not this, that's a different conversation. We're talking here about AI trading your investment money. Now, these are the actual performances. These are real. These are what we've done. I like to say we are the solution to the current problems that I introduced in the beginning. You know, we give you equities, crypto, individuals, or combined. You can also buy and sell. If you just want to trade stock and you want to do it yourself or crypto and you don't want the AI to help you, guess what? Our platform is completely free. Don't let everything you see on the website fool you. We have a platform, you saw our purpose, for everyone. You got 5 grand, you got 10 grand, you got 20 grand, we have people on our platform with over $1 million on it. There is no limit to how small or how big it can be. You don't need any of that stuff. Our flat monthly subscription is just that. It is designed to help you take advantage of not having to pay all those extra fees that go into all the different types of solutions today. So I'll give you one quick look. I'm going to wind it down here. I know I want to give you guys time to ask some questions. This is what the dashboard looks like. Just a simple snapshot. I just grabbed it a couple days ago. You know, it gives you the total value. And look at this. I wanted to show this. This is a $118,000 account. Only 16,000 of it is in cash. And look what type of an account it is. It's a self-directed account. It's a self-directed account that somebody has on here. It's got 118 grand in it. Only 16,000 of it's actually in the market. And this was late last week when I snapped this. So it goes to show you that you don't need all your money working to make money. And just to give you an idea of how simple the home screen is. So we have one simple offer for you guys. We want you to get educated. I'm giving you 2 ways to do it. You can just text that word, the word invest, to that phone number, 480-418-0300, or you can just visit iFlip webinar. We're doing a webinar here for you today. You can do iFlip webinar, and you can schedule an appointment to have a private walkthrough one-on-one, so the world doesn't have to hear about what you're doing financially and where all your money is and all that. You can just talk to one of our people, see what works for you. Is it 10 grand? Is it 100 grand? Is it millions? Doesn't matter. We have a spot for all of you, and you're gonna like the way we price it. You'll never pay more than, I think the max out at where you could pay the very most on our platform, you're well under 2%. So, that is it. The bottom line is this, AI, it's more effective than a human managing your money. And that's only true always.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.